Welcome to This Explainer. Today, we're unpacking a really wild situation, the violent market momentum, and honestly, the extreme fundamental dichotomy hiding inside Wolfspeed's Q3 2026 earnings. If you followed the semiconductor space at all, you already know Wolfspeed has been making some massive waves lately. So we're going to dig into the hard numbers, their recent strategic pivots, and the very real risks that are driving this stock's absolute roller coaster ride. All right, let's just start right here with this number, 24.59%. I mean, wow. A single-day stock jump like that is the kind of price action that instantly grabs Wall Street's attention. And, this wasn't just a random one-off spike. This leap basically capped off a period where Wolfspeed's share price nearly tripled. We're talking rocketing from around $24 to nearly $67 in under a month. A lot of this was driven by really aggressive momentum trading, plus the market taking a fresh look at their underlying tech story. But here's where it gets kinda crazy, right? There is this jarring tension between that aggressive trader optimism and a balance sheet that is, well, bleeding. On one side, you've got this rocketing stock price crossing $66 and massive intraday swings that momentum traders absolutely eat up. But look at the exact same day on the fundamental side. Wolfspeed is posting deeply negative EBIT margins. We're talking negative 204.5%. It's literally a classic battleground scenario between market hype and traditional value metrics. So you got to ask yourself, how on earth does a company with such deep financial losses, negative gross profits, and this heavy cash burn command so much optimism? What exactly are these traders seeing that traditional value screens are totally missing? Well, we're going to answer exactly how management's strategic pivots are managing to convince the market to look right past that cash burn. Actually, the answers to that question are hiding in plain sight inside their Q3 2026 earnings report. When you really dig into the transcript and the raw data, three distinct turnaround pillars start to emerge. Basically, we're looking at a massive restructuring of their balance sheet, a major operational shift in their factories, and a highly targeted pivot toward high-growth markets like AI. Section 1. The red financial reality. Okay, looking at the financial snapshot here. The big takeaway is that, yes, they did hit their revenue guidance of $150.2 million for the quarter. But, and it's a big but, the margins and bottom line still deeply in the red. We're looking at a GAAP net loss of almost $120 million and a non-GAAP gross margin of negative 21%. Basically, they're burning through cash as they spend heavily on new plants and equipment to scale up. And if you're wondering what's specifically dragging those margins down so hard, you have to look at this number. $46 million. That's just their quarterly underutilization charge. Management actually called this out as the primary anchor on their gross margins. Essentially, it's like having a giant state-of-the-art factory, but until market demand catches up and you're fully using it, well, all that empty capacity costs tens of millions of dollars every single quarter. Section 2. Restructuring the balance sheet. So, knowing they're burning all this cash, management didn't just sit on their hands. They tackled their debt head-on. They raised about $476 million through private placements. But instead of just hoarding it, they used it to slash their absolute highest cost first lien debt by an incredible 43%. We're talking about chopping away a debt that had an interest rate of 14% and was about to step up to 16%. By doing that, they instantly improved their flexibility and are estimated to save a staggering $62 million in annual interest expenses. That's a real game changer for their runway. And check this out. This shows how fixing regulatory hurdles can directly repair your balance sheet. During the quarter, they finally secured clearance from CFIUS, that's the Committee on Foreign Investment in the United States. That finalized their partnership with Renaissance and released a bunch of equity. When you combine that with the debt refinancing we just talked about, this single event dramatically boosted their equity position by over $400 million. They radically improved their debt-to-equity ratio in one fell swoop. The result of all that? They wrap up the quarter in a much, much stronger defensive posture. They're sitting on $1.2 billion in total liquidity across cash, equivalents, and short-term investments. This war chest is absolutely crucial right now because it ensures they actually have the runway to fund their biggest factory build-outs over the next 12 months without the constant panic of running out of money. Section 3. Shifting production to Mohawk Valley. Now for operations. This structured shift is the core of their entire manufacturing turnaround. Step 1. They shut down their older 150mm device fab in Durham, and they actually did it ahead of schedule. Step 2. They're shifting all that device production over to their massive, state-of-the-art 200mm fab up in Mohawk Valley, New York.
This is huge because Mohawk Valley already handles 90% of their power product revenue, and it's way more cost-effective. Then, step 3, Durham transitions entirely into a materials and next-gen 300mm substrate hub.
Management specifically called this out in the earnings report. By eliminating that older, less profitable device production in Durham, they're clearing the decks to really maximize their earnings potential there. They can just leverage the tools they already have for materials production without needing to dump a ton of new capital into it. It's a classic efficiency play, you know? Do more of what works exactly where it's cheapest to do it. Section 4. AI data centers drive growth. Okay, we know the EV sector is cooling off a bit, but look at this, a surging 30% sequential growth in AI data center applications from Q2 to Q3. This is exactly what those momentum traders are betting on right now. The energy demands for AI are just staggering, and these data centers are absolutely desperate for high-efficiency power components to handle the load. Wolfspeed is stepping right into that gap. And they aren't just crossing their fingers and hoping for the best either. They are launching specific hardware to meet this demand. This quarter, they rolled out the very first commercially available 10 kilovolt silicon carbide power MOSFET, along with a next-gen TOTLT portfolio. Simply put, these are highly specialized components tailored directly for the super heavy 800-volt architectures that modern AI data centers need just to power and cool themselves. To actually capture all this global demand, they've totally revamped their go-to-market strategy. They're pivoting from just selling products to focusing on whole applications. Plus, they brought in some heavy hitters, like hiring Yasuhisa Harita as president for Asia Pacific to aggressively push into Japan, Korea, and ASEAN markets. They've also beefed up their legal and communications teams, which tells us they're gearing up for complex international deals, managing government subsidies, and navigating strict regulations. Section 5. What to watch next. Management has drawn a very clear line in the sand with their Q4 guidance. They are projecting revenue between $140 million and $160 million. Crucially, they expect operating expenses to stay flat. But, and we have to keep this in mind, they totally acknowledge that gross margins will continue to be negative while they wait for factory utilization to catch up. Believe me, traders are going to be watching like hawks to see if they can hit the top end of that revenue range. Which brings us to the ultimate test of this entire turnaround. Can Wolfspeed actually hit that high-end $160 million target and outrun this massive burn rate? I mean, they have the liquidity for now, and their tech is undeniably positioned perfectly in front of massive trends like AI infrastructure. But translating billions in capital expenditure into scaled, positive profitability, that's the final hurdle. It's something every active market observer should be watching incredibly closely over the next few months. Thanks for joining me on this explainer, and we'll see you next time.